The biggest misconception I've seen in many beginner day traders are that they're always on the quest to find the best penny stock trading patterns, the best strategies, the best indicators, etc, etc. What most people fail to realize is that those things only work if people use them. So in order to profit, we must think for the buyers and sellers and understand who are the players and who is in pain. The 5 most common players in the penny stock market are breakout traders, momentum traders, dip buyers, swing traders, and short sellers. I'll be breaking down the basics of these traders' psychology, so you will be able to analyze and profit from day trading beyond just memorizing patterns and strategies. I've spent a lot of time preparing for this video all by myself to make sure there's 100% value and 0 hype. So if this sounds like something that can help out your trading a lot, make sure to watch till the end and drop me a like so others can benefit from my videos as well in the future. So the first one we'll go over here are the breakout traders. These are the traders who will buy into a penny stock when it's about to break a previous high. Let's take a look at the chart for ABIO intraday. So on May 1st, the stock got pumped up by PR and traded as high as $9 from around $5 at the open. It sold off a little bit during the day and retested a previous high at around 1:20 in the afternoon. So at this retest of previous high around $9, breakout traders see that, hey, the stock is about to make a new high, and they think to themselves that I can see the stock break above $9 and possibly go up to $10 or even more. So I must get onto this. Breakout traders are the most predictable traders in the market because it's the most common strategy taught in many penny stock courses, chat rooms, DVDs, etc, etc. They term this strategy the breakout pattern, the U-shaped breakout pattern, the survival, revival, or whatever breakout pattern. This is very important and we'll come back to talk about this in detail later on, so hold on tight. So this is why you see the increase in volume in ABIO around the previous high of $9 price level as more breakout traders hop on into the stock. So the stock takes out the previous high of $9 and run higher to $11.50 and then almost $13 at 2 p.m. So once all the traders who are watching ABIO, they see that the stock has just made a new high breaking above the previous resistance. So this is when the momentum traders get interested. This is what those players are thinking. Oh, that stock, the breakout on ABIO was successful. And when the stock breaks the previous high successfully, it's really likely that more volume are gonna pile in. So I should hop on into strength as well. So these momentum traders buy into the stock along with the breakout traders. So that's why many times when penny stocks break a previous resistance level with strong volume, the price will likely to squeeze even higher. Remember this, momentum traders join strength. And of course, when strength weakens, this is when the momentum traders will sell their positions and get out of the stock. So you can see right here on this 10-minute candle on ABIO, the breakout traders who got into the break of the previous high of $12.69 failed. The stock only went up about 20 cents higher at $12.88 and really quickly slammed down to $11. So that's a sign of weakness in extension. And when the stock no longer has the strength to push higher, this is when the momentum traders who got in earlier start to sell. And there were not enough fresh breakout traders coming into the stock. So the increase of selling and decrease of buying causes a sell-off from around $12 back down to $10 and below. So this weakness is where the third kind of players come in, the short sellers. Short sellers love to lurk at the top of each stock. These are the traders who can spot the increase of selling and decrease of buying on the volume and level 2. Short sellers love overly extended stocks on a day like ABIO. So these short sellers see ABIO and they think to themselves, okay, the stock ran from $5 to almost $13 today. This is overextended. I think the buying of the stock has slowed down and the selling is going to increase now. So I want to short this stock down. So in this case, if the short seller entered at the top of $12.80, he or she was correct on the thesis and they made profits from the stock falling all the way down to below $10. However, there are always short sellers who are very impatient. Some traders who just love to short everything that's up. And remember, the previous high was $9 from the morning. So I bet there were a lot of short sellers taking entries and piling on at $9 again later on around 1:20 p.m. Well, all those short sellers got in too early. There were more breakout traders and momentum traders buying and then overall selling into the stock. And this stock was breaking out to new highs. So when that happens, these early short sellers who were too impatient, they start thinking to themselves, holy think this stock could possibly break $9 and now it's breaking above $10 now. I'm down a lot of money. I thought this breakout was gonna fail, but I'm wrong. What if it goes to $20 or even $30 parabolic? Oh my god, I better get out of the stock before I blow up my account. So these short sellers who are in pain decide to get out. And when they get out of their position, they need to buy to cover. This is what causes a short squeeze. The short sellers buying along with the breakout traders and the momentum traders buying causes the stock ABIO to squeeze even higher. So let's get back to the successful short sellers here. If I was a short seller who shorted at $12.80 and now the stock is down to around $9, I would start covering a piece around this level. Why? Because I know that dip buyers are going to start coming in. Dip buyers are the fourth kind of players you need to keep in mind of. These are the traders who love to buy into a stock when they see that the stock has made a new high and retraced back down to previous support level. Dip buyers love to buy into the stock on pullbacks after the stock has shown impressive strength to the upside. For example, the dip buyers will be looking at this $9 level here and be thinking, the stock was just trading around $12. Now that it's pulled back, I can buy into this at a cheaper price. The previous resistance level was $9, and previous resistance, once broken, becomes support. Okay, $9 is a support price, and I think it's a reasonable price to buy into here. And at the same time, short sellers are looking at the same level at $9 and thinking to themselves, okay, I need to beware of dip buyers. They may be wanting to get into the stock at this level, so I better start covering up. And it's this exact balance between all the players in the market that create these support and resistance levels. Dip buyers came in to buy at $9 and short sellers came in to buy around the same level. So that's what makes the stock price bounce from $9 again to $11.70. And this bounce pattern only happened because dip buyers and short sellers came in to buy. This is why I've stressed in so many of my previous videos, don't focus on memorizing patterns. Focus on understanding the players involved in the stock and what they are doing to form those patterns and the price action you're seeing right now. You have to think for the other traders. And there's more, I'm not done yet. So at the end of day one, this stock, ABIO, closed around highs of $9. So the next day, on day 2, we can see that the stock gapped up overnight to $19 pre-market. This is when the fifth major player comes in, the swing traders. Swing traders are people who love to buy a stock and hold it overnight. That's showing impressive strength and holding the gains really well, which is an important criteria I've mentioned in my penny stock buy overnight strategy video. So the swing traders who are looking to buy will be thinking here on day 1, okay, this is only day 1 of this move on ABIO. This penny stock is holding up its gains really well and haven't been sold off yet. I think the news release could potentially drive even more buyers coming into the stock overnight. Then in that case, I can sell my position at tomorrow's gap up or the spike in the morning. So the next morning, guess what? These swing traders are laughing to the bank. The stock is trading at $19 pre-market, and the swing traders are thinking to themselves, wow, this is amazing. I just made $9 a share in less than 12 hours. I better lock in some gains just in case the stock sells back down to $10 again. At the same time, let's think for the breakout traders who are following chat room alerts. Remember, I mentioned earlier that we'll come back to these people? The most common day trading strategies out there are buying breakouts. Buying the breakouts of previous day's high, pre-market highs, intraday highs, etc, etc. So let's put short sellers into consideration as well. As I mentioned earlier, there were shorts piling on around $12.80 on day 1. And they probably held overnight because they think the stock could sell off even more back down to $5. So let's put all these pieces of the puzzle together. The breakout traders, the swing traders, and the short sellers. Swing traders, after profiting $9 a share overnight, what do you think they're likely to do at the market open? They probably want to sell their position and take their 90% ROI and run. Short sellers who are holding overnight from $12.70, they are down $7 overnight. They probably panic and want to buy to cover at the market open. Breakout traders, the most common traders in all these penny stock chat rooms, they probably get an alert to buy at the break of pre-market high of $19 and sell at the next whole number resistance at $20. So at the market open, breakout traders pile on to buy at the pre-market high of $19, and short sellers buy to cover. Those two players together buying drove the share prices up from $18 to a high of $20.45 at the market open. The swing traders who got in the previous day, they want to cash out on their overnight position, either on the gap up or the market open spike. So they start selling their overnight position at the same time and taking home their profit. The amount of selling outweighs the fresh buyers and short sellers covering, so the price did not go that much higher, only by like 40 cents. This is when the chat room followers and the breakout traders panic. Oh I thought the stock was going higher to 25 or 30, but now it's breaking down below pre-market highs at $17 now. Better cut my losses before the stock tanks back down to $5. So all these breakout traders who are stuck buying at $19 or $20, they start selling as well. Now, the smart short sellers who didn't get squeezed from their overnight positions, they will be lurking around this pre-market high. They will be thinking to themselves, okay, the stock just gapped up $9 overnight to $19 now. If I was long and I was up so much, I would totally sell and take some profit. So I think this stock could potentially spike a little bit more at the open, with all the chasers chasing and all the immature shorts covering. But I think ultimately there will be more profit taking than the buyers. So I want to take this stock short. Basically, this thinking is the foundation of my gap up strategy in my previous video. This is the cause and effect relationship between all 5 players in the market that is so crucial to understand. Remember, chart patterns are only byproducts of psychological decisions to buy or sell. This is why no patterns or strategies are 100% guaranteed, because the buyers and the sellers in each stock are completely different. If the dip buyers on ABIO on day 1 didn't come in to buy at $9, do you think the stock would have bounced? And do you think this bounce pattern would have occurred? And if there weren't enough breakout buyers buying then selling, do you think any of this breakout on ABIO would have been successful? Most people think to make money day trading penny stocks, you need to understand the stocks really well, to understand the market and all the patterns really well. Sure, that could help certainly, but really it's not you against the market. It's you against the other people in the market. This is why I believe day trading psychology is so important. You have to think for the other players involved as well. And this is the kind of psychological analysis that will separate you from the sheep that follow the chat room alert and study just the patterns. Yes, know the patterns, they help, but don't just trade the chart patterns. Understand the traders in the stock and trade those traders. I have a lot more trading psychology video ideas in mind, but I'll only do them if you guys actually enjoy these videos. So comment down below and let me know if you find it helpful. Hopefully you can tell that I put so much effort into creating these free videos for you guys. Each one of these videos take me about 10 to 12 hours to make. All I ask in return is to please drop me a like on this video and comment down below. It really does help a lot, and that will encourage me to make more videos like these for you guys in the future. And don't forget to subscribe and ring that bell icon to get notified first whenever I post a new video. This is the Humble Trader. Thank you guys for watching, and I will see you next time.